Increasing return and reducing risk in stock investing. Investing money is risky. One way to reduce risk is to invest in government bond, so you are safe from volatility of stock market, but returns are very low. For higher returns, people invest in shares, for also known as equity stocks, but higher returns come with higher risk. There's a lot of volatility. Can you sleep well? Is there a way to mitigate risk? One way is to diversify. So invest in a basket of shares, for example, mutual funds. So some shares go up, some go down, and then you get um, a mixed return which is not very high or not very low. The key is to have a mutual fund which has good quality stocks. Now let's look at a car insurance example, um, which is not related to investments, and we will use this as an analogy. Suppose you buy a car for $28,000 and you buy insurance which pays the amount of loss if any loss happens. Um, they will pay up to 28,300, and suppose they charge $200 per month, which is like $2,500 each year, which is about 8% of the purchase price. You are paying that 8% to sleep well, that okay, if any loss happens, I am protected. So can we protect our investment similar to car insurance? Before we go further, let's consider put options. What is a put option? It is a right to sell at a fixed price. For example, an option to sell a share at 285 regardless of the current market price. So for example, you bought a put option of 285 and the share price goes down to say 200, and you have those shares, then you exercise your option and sell the shares at 285. So this is this sounds good. Such options are available for widely traded stocks and exchange traded funds. Mutual funds do not have options though. So now let's start. An example. Um, so most people invest in mutual funds, and mutual funds charge a high fee each year. For example, 2 to 5% of the account value. So even if your fund is falling, the fee will be charged. Over time, these fees add up, and you see that a lot of your return is eaten up by the fees. In contrast, an exchange traded fund charges negligible fees. So first of all, we will select an exchange traded fund. An ETF or S&P 500 index has symbol SPY. Let's select this one because SPY has like 500 companies, and SPY has options available. SPY price on June 5th, 2019 was 282, and you can see this is a snapshot from Yahoo Finance, and you see that 52-week range was like 233 to 295, which is like um, a 20% volatility. So what is our strategy? We buy 100 shares of SPY at 283. The total value of investment is 28,300, and we want to save ourselves some losses, or we can even make money from the volatility. So to do that, we buy a put option, and let's see what is the price of the put option. Put option price on 5th June around the same time, like in the afternoon. It was like 1947. So for 100 shares, this is like 1946. So we buy a put option. This was actually 1 year put option. So we buy one put option which is 400 shares, and the cost is 2000, almost $2,000. Suppose something bad happens during the next year, and a recession starts or trade war appears and the markets fall, then S&P 500 falls to 2000 level, which means that ETF SPY falls to 200 and our shares value falls to 20,000, which is a loss of 30%. But wait, we are protected. I can exercise my right to sell the shares for about exercise price of 285. I will get 28,500. So regardless of the current price, which is like 20,000, I'm getting 28,500 because of the put option. Alternatively, I can sell just the put option and keep the shares. I will get at least $8,500 for selling the put. So I'm making like 6,500 or 6,000, yeah, 500 on the option. I will keep the shares, which will be valued at 20,000, and I can even buy another put option to save myself from further downside. So we see that this insurance premium of 1947 helped me weather the storm. The put option saves the day. So here is more information you can get from these books and the link to get the quotations. Thank you.